Today is September 16, 2024. The impact of elections on markets and tax policy. With Labor Day behind us, we're in the final stretch of 2024 presidential election race. As we follow the news and parse the most recent polls, some may ask, how might what happens on November 5th impact my taxes? As financial professionals, we've done some homework and came up with the following conclusion. You may care passionately about who wins, but your investment portfolio probably doesn't. Markets over the long term. Consider how the stock market has performed under Republican and Democratic presidents throughout history. As the accompanying chart shows, which I have on my blog, you can check it out, www.northboundwealth.com. The stock market has fluctuated under the leadership of both parties. However, the long-term trend suggests that the stock market's performance may have more to do with the overall strength and resiliency of the U.S. economy than the person who sits in the Oval Office. That's pretty obvious. One person doesn't dictate how the broader economy in the United States is actually going to perform. Now, that one person may impact downstream the particular appointees of certain agencies within the government that eventually could trickle down to the local levels and affect our economy overall. And I do believe there is an impact there. But leaving all politics aside, the market's trend is apolitical. We've got from 1943, the growth of $100 with Democratic presidents, Republican presidents. You can see each period of time's return during the course of their administration. And then all from 1943 all the way to 2023, you can see that your money would have grown under both administrations because the economy grows under both administrations. Sometimes it's toggled up or toggled down based on how things work out policy-wise and how much debt that we issue and things like that, taxes, all that stuff. Is a split government better for the financial markets? That's a good question. So while the stock market performance is not historically dependent on who wins the presidency, history shows that the market tends to like split control between the two major parties. There's a tendency for that because of the checks and balances of it. That's the financial markets. They like that. Maybe people don't, though. As the chart below illustrates, Democratic control of the White House and Senate with Republican control of the House has produced the highest average annual return. Not that that's what we're going for this time around, right? However, the runner-up is the opposite, a Republican president and Senate and Democratic House. While mixing and matching control of the levers of power in Washington, D.C. produced comparable results, the low results for the Republican president and Democratic Congress combo may be attributed to the 1973 oil crisis and the 2008 global financial crisis, those two bear markets. So financial markets are not partisan. Average annual S&P 500 performances bipartisan control. So what we have is another really good chart by bairdwealth.com, March 14th, 2024. They kind of go through the different scenarios, which I won't on this podcast due to time. But you guys can check it out, my blog at www.northboundwealth.com, and just click on the blog link. What matters to the markets? So following how election results have affected the stock market over time is pretty fascinating. Still, data suggests economic trends tend to have more consistent relationship with market performance than who wins in November. Improving economic conditions, which can include falling inflation trends, tends to create a more favorable business environment. Obviously, if inflation is going down in our current environment, that's really good for consumers and businesses. But we need interest rates to kind of follow suit and not do that too quickly and not do that in lag too slowly. And so this engineered soft landing scenario is what the Fed is currently trying to do. Tax policy differences. So what also can have more of an impact on your personal finances is tax policy, obviously. And while there may be some bipartisan common ground, this year's election does present two competing visions on taxes for individuals and families. Let's look at where each party's candidate stands. Keep in mind, this article is for informational purposes only and is not a replacement for real-life advice. The tax policies outlined are based on assumptions and will be subject to revisions during the legislative process. We encourage you to consult your tax, legal, and accounting professionals before modifying your tax strategy. So the fate of the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act, or TCJA, of 2017 was designed to overhaul the federal tax code by reforming individual and business taxes. Although some of the provisions were permanent, most individual tax changes are not. Unless extended, many of the changes implemented are scheduled to sunset on December 31st, 2025. So at the end of next year, not this year, but next. At that time, rates will revert to pre-2017 levels. There have been some speculation that many of the provisions of the TCJA would be allowed to expire. However, based on the announced tax policies of both candidates, the lower rates may remain for the vast majority of taxpayers, those with incomes of less than $400,000 per year. The significant difference between the two proposals is the tax treatment for those making more than $400,000. Keep in mind that the president can lay out a tax policy, but it is up to Congress to pass any tax legislation into law. Higher income individuals should be aware of the potential changes that may impact their tax situation, depending on the future of the TCJA. By being diligent, you may be better prepared for whatever comes down from Washington. We always welcome collaborating with your tax professional to help align your financial and tax strategies. Staying the course. While elections can trigger some market volatility, which we've seen, it's critical to keep short-term events in perspective and not allow them to distract you from the long-term financial strategy. The best approach is often to create a portfolio that reflects your goals, your time horizon, and your risk tolerance. We're here if you have any questions. We're here to help. If you are a current client and want to discuss your strategy, please let us know anytime. If you are working with another financial professional and would like us to review your overall approach, please consider reaching out. Stay tuned for the next segment. The weekly market insights. Stocks rally ahead of the Fed meeting. Stocks rallied last week as investors received better than expected consumer and producer inflation data. The Dow Jones Industrial Average rose 2.60%, while the S&P 500 index gained 4.02%. The Nasdaq Composite led, picking up 5.95% as tech stocks rebounded. The MSCI EFA index, which tracks developed overseas stock markets, rose 1.01%. Stocks bounced out of the gate at the start of last week as risk-on investors made moves before the pending release of the twin inflation reports, the CPI and the PPI. The three major averages added slightly more than 1% on Monday trading. On Wednesday, stocks initially dipped following the release of the CPI as traders appeared disappointed by the report. By midday, sentiment changed. The S&P 500 down as much as 1.6% in early trading, gained 1.1% by the closing bell. More inflation data out Thursday showed wholesale price increases were tempered, which helped stocks moves higher. More inflation data out Thursday showed wholesale price increases were tempered, which helped stocks move higher through the balance of the week. I got Y charts on here, weekly market insights, major index returns. You can check it out on the blog, on the website. Year to date, the Dow Jones is up 10.55%, MSCI EFA is up 9.52%, Nasdaq's up 17.65%, S&P 500 is up 18.47%. The 10-year Treasury note closed at 3.66%. Small caps shine. So small cap stocks as measured by the Russell 2000 have pushed higher into recent weeks, which is a telling move for some Wall Street observers. The Russell 2000 has outperformed the S&P 500 by more than 4% during the third quarter of 2024 so far. One reason is that smaller stocks tend to respond when they anticipate interest rates will trend lower. Investors appear to be positioning themselves in small cap issues, expecting the Fed may adjust rates at its September meeting as it looks to guide the economy to a soft landing. So this week, key economic data, we're looking at Monday, Empire State Manufacturing Index, Tuesday, FOMC meeting day one, retail sales, industrial production, Fed official Lori Logan speaks. Wednesday, FOMC meeting day two, housing starts and permits, FOMC announcement, Fed chair press conference Thursday, existing home sales, weekly jobless claims. Friday, Fed official Patrick Harker speaks. So who knows if we'll get the rate cut this week or not. We'll see when they're actually going to do that, if it's going to be a quarter basis point or 50 basis points or a whopping 75 or 100 or 1%. I doubt that much, but I probably am going with like 25 or 50 basis point rate cut, which will begin the new rate cutting cycle. We'll see what their guidance is on the pace of those rate cuts over the next 12 to 18 months. So key notable companies reporting earnings this week, kind of a light week, General Mills and FedEx. We'll check them out. And then check your withholding status online. This is your tax tip of the week. The withholding calculator can help you determine whether you should submit a new W-4 to your employer, and you also can use the results to adjust your income tax withholding. If you have a more complex tax situation, you may need to use Publication 505, Tax Withholding and Estimated Tax Form, so paying estimated taxes. This form can help you determine your self-employment tax, alternative minimum tax, or tax on unearned income by dependents. Publication 505 can also help if you receive non-wage income, including capital gains, royalties, dividends, and more. Checking your withholding is essential to deducting the right amount of taxes. These handy tools can help. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional, and this tip was adapted from irs.gov. Stay tuned for the next segment. Hello, everyone. In this segment, I want to talk about sector highlights of the S&P 500. So it's the sectors and industries performance, breaking down the S&P 500. So just as a starting point, the S&P 500 year to date is up 18.0%. And over the last 12 months, it's up 25.9%. So keep that in mind as a frame of reference. The majority of that performance is coming from the attribution of information technology. So the tech sector is the top performer year to date at 25.6%. Over the past 12 months, it's up 41.0%. So actually, that space is outperforming the S&P 500 over the last 12 months. Utilities is up 23.2%. That's a bit surprising. That sector kind of beat out communication services recently here. So as we've had a pullback in comm services. So utilities 23.2% over the past 12 months. It's actually up 22.7%. So coming in an underperforming manner over the past 12 months, even of the S&P 500. So communication services is up 20.8% this year. Over the past 12 months, it's up 29.5%. So even though it's down year to date relative to the S&P, it is still outperforming on the 12-month basis of the S&P 500. Financials comes in next. It's up 17.2% this year, up 28.1%. So it's also outperforming the S&P 500 on the last 12 months. Consumer staples is next at 17.1%, kind of like tied with the financial sector this year. But consumer staples are only up 18.2%, so kind of trailing there, but catching a bit. Healthcare is only up 13.9% this year and is only up over the past 12 months, 17.4%. So they're kind of in a soft patch, which I expect could turn actually if things go a little bit better. Industrials is next at 13.3% year to date, up 24.4%. So industrials are outperforming healthcare over the past 12 months. Real estate, not as hot as it has been in the past, obviously with higher interest rates. Real estate sector of the S&P 500 is up 12% this year, 23.5%. So slightly underperforming the S&P 500 again, which was at 25.9% over the past 12 months. So real estate's kind of just keeping up. Consumer discretionary is only up 8.7% this year, 14.1% over the last 12 months. So kind of an underperforming sector of the S&P 500. Materials is next, 6.2% year to date, 13.6% over the past 12 months. And then energy coming in last at only up 1% this year, down 7.9% over the past 12 months. So after a pretty hot 2023, being one of the top performers, is now one of the worst performers of the S&P year to date. So we're going to be tracking all the sectors as we progress through the end of the year. I do want to touch on valuations. So sometimes you'll hear people talk about, well, what are the valuations? Is it getting overbought or oversold? S&P 500 is trading at 28.65% price to earnings ratio, and the dividend yield is 1.3%. Real estate is at a 47.10% PE ratio with a div yield of 3.4%. Healthcare 46.8 at a 1.5% div yield. And then tech, information technology is trading at a 40.68 multiple with a 0.6% dividend yield. Materials 29.83 PE ratio, 1.7% dividend yield. Consumer staples 28.24 for the PE and 2.3% for the dividend yield. Industrials 28.07 with a 1.4% dividend yield. Consumer discretionary 27.5 at a 0.8% div yield. Communication services 26.07 and then a div yield of 0.9%. Utilities 21.49 PE ratio, then a 3% dividend yield. Financial 17.88 PE ratio, 1.7% dividend yield. Energy at a 12.30 PE ratio at a 3.5% dividend yield, so a higher yield. Highest yield would be traditionally, and seems to always have been in energy, but that multiple of 12.3 is pretty low. And obviously, there's an underweighting in the S&P now because of the decline in energy. It used to be a higher percentage, like I think more than 5. I think it was higher than that. I'd have to go back and look at some data to confirm that a little bit more. But looking at tech and healthcare and real estate, those are the higher price to earnings multiples that and ratios that people are looking at and comparing. And then you got the S&P at a 28.65% PE, which I covered at the very beginning of this. And so it's a little bit rich on the valuation of the S&P 500. And then I drill down, look at the largest weight, which is technology. And if tech space is at a 40 PE ratio, and then is the largest weight of the S&P, that all makes sense why the valuation is up. So gosh, maybe if we get a pullback and the PE ratio drops into the 27, 26, 25, those are times to be potentially looking to add exposure to those areas. But again, not advice, just reviewing the valuations and looking at the different sectors of the S&P 500. I came across this article in the September edition of the American Association of Individual Investors. It's entitled 6 Lessons of Investment Loss to Keep You Winning. It's by Andrew Stotz. He's a PhD CFA and has over 30 years of experience as a financial analyst and was twice voted as Thailand's #1 financial analyst. He hosts the podcast, My Worst Investment Ever. And you can find out more by checking him out at www.aai.com/authors/Andrew-Stotz. I think it's Stotz, Stotz. Great article, and I wanted to share it with my listeners because I think we can all learn something. Again, 6 lessons of investment loss to keep you winning, stories of investing loss that underscore the importance of preparation, vigilance, and learning from others' experiences. I think we can all say that we have made mistakes in investing, and it's from our mistakes that we can learn the most, if you choose to learn. So here we go. Let's dive in. Have you ever made a disastrous investment? My worst investment ever was sinking money into a friend's startup, resulting in a painful and embarrassing loss. I tell you about it in this article. He writes, have you bought an investment you later realized was a mistake? I know that I'm not alone in making investment decisions and I later regretted. I know this to be true because I started the My Worst Investment Ever podcast in mid-2018 to interview people about their worst investment experiences. 6 years and 800 interviews later, I've uncovered 6 common mistakes. I share them, along with 6 stories from guests on my podcast who made such mistakes to help you avoid them. So, mistake number 1, failing to do your own research. Josiah Smeltzer is a licensed real estate agent who operates an investment property business with a partner. He shared his story in the episode, Pushing Through When Everything Goes Wrong. The perfect flip dream turned sour. Many real estate investors dream of achieving the perfect flip, a quick buy, a swift renovation, and a profitable sale. Eager to enter real estate, Smeltzer devised a plan: buy low-priced housing, fix them up, sell them for a profit, and use the earnings to acquire rental properties. He found a seemingly promising investment, a house far from the city center but attractively priced. On the day Smeltzer was to close the deal, water rushed through the bathroom ceiling. Despite this warning sign, the seller's significant price reduction convinced him to proceed. This was a decision he would soon regret. From termites to armadillos, the nightmare begins. So Smeltzer then skipped a property inspection to save time and money. Unfortunately, he discovered extensive termite damage after purchasing the house. As renovations progressed, he uncovered mysterious holes in the backyard. Pest control revealed an unexpected armadillo infestation, adding to the costs. Further complications included rotted wood around the windows, in turn stretched his budget. With the house finally ready for sale, Smeltzer faced another setback. He arrived with the first potential buyer only to find the front yard swarming with hornets. This required another costly pest control visit. Months passed before another buyer showed interest. Then, the buyer returned with a home inspector. The home inspector identified 30 issues needing attention. Smeltzer painstakingly fixed all of them, only for the buyer's appraiser to find 15 more. Finally, the buyer found 6 additional problems close to the closing date. These problems included water damage to the foundation. So, last-minute chaos and cleanup. In a frantic race to meet the closing date, Smeltzer fixed everything. However, a chimney cleaner accidentally blew black soot into the living room on the closing day, necessitating a last-minute cleanup. With mere minutes to spare, Smeltzer and his team cleaned and painted the walls, finally making the house presentable. Takeaway: costly lesson in real estate. Smeltzer sold the house at a significant loss of $20,000. Beyond the financial hit, the experience cost him precious time and delayed his business plans. The ordeal taught him the importance of thorough research and due diligence, highlighting the true cost of missed opportunities and lack of preparation. Smeltzer's story leads us to lesson number 1, failing to do your own research. To avoid this, consider writing down your research about your investment idea, whether it is a house, stock, fund, etc., and the potential gains you expect to realize. Investing mistake number 2, failing to properly assess and manage risk. Author of 2 #1 best-selling books on Amazon, Money Grows on Trees in 2019 and The Naked Trader 2020, and CEO of Real Life Trading LLC, Jeremy Newsome told his story in the episode, quote, "Stop trying to hit the home run trade," end quote. Basically a young investor's journey from Apple to silver. So, inspired by Forrest Gump's success with Apple, ticker symbol AAPL, Newsome convinced his father to give him money for investing. Newsome exited his first trade with excellent gains. This made his father happy and willing to further support in his son's newfound success. Buoyed by the early win, Newsome's father decided to go all in as Newsome turned his attention to investing in fast-rising silver. Unfortunately, the second investment didn't go as planned, as Newsome bought just before a peak. Being a novice to the world of investing, he failed to consider a risk management plan to handle the market's volatility. A derivative disaster. To make matters worse, Newsome's investment was not in physical silver, but through derivative investments, a risky move. So not directly in it, but something that's a secondary to or a derivative of silver. As silver's price plummeted, Newsome faced a 100% loss. The real blow came when he realized his father had given him his entire retirement savings, making this a devastating loss. A takeaway: a hard lesson in risk management. Newsome's oversight was not considering the downside risk. The experience taught him the harsh reality of speculation and the importance of managing risk. The painful lesson: always protect your capital and be cautious when everyone feels excited about an investment. The lesson for his father was to never allocate all your money to a particular investment opportunity. Newsom helped us understand lesson 2, failing to properly assess and manage risk. To avoid this, separate your research on return from your research on risk. Then rank risks by probability and severity. Finally, use your research analysis to create a risk reduction plan in case the investment does not go your way. Investing mistake number 3, being driven by emotion or flawed thinking. Jim Ponvanet is the founder and CEO of Pure Power Platform Company Limited, a fintech startup focusing on the small and medium-sized business marketplace lending in Thailand. Ponvanet shared his story in the episode Apply Behavioral Finance Principles to Make Better Decisions. Ponvanet, who has seen gains in U.S. stocks post-2008, became obsessed with investing in market volatility in 2015. He invested 50% of his portfolio in the iPath S&P 500 VIX short-term futures ETN, or exchange-traded note, which is ticker symbol VXX, on the belief that volatility had bottomed out. Overconfidence and stubbornness. After a 40% loss in 4 months, Ponvanet doubled down. In doing so, he ignored opposing views and put the rest of his money into the falling investment. Though he was exposed to a myriad of opposing opinions by seasoned professionals, his belief in his research led him to disregard market signals and criticism, a costly consequence. By early 2017, Ponvanet sold his position. The total loss was equivalent to 70% of his initial investment. His story illustrates the dangers of overconfidence and the importance of listening to contrary opinions. The key takeaway: never ignore market realities and avoid information selection bias. Lesson number 3 is about making the right decisions. The mistake is to be driven by emotion or flawed thinking. To avoid this, find, explore, and list opposing views. It is a good idea to discuss your ideas with a knowledgeable and objective person, like a financial advisor. Investing mistake number 4, misplacing trust. CEO, venture founder, speaker, and author Azran Osman Rani shared his story in the episode From Zero to a $1 Billion IPO. A CEO's gamble for skin in the game. Osman Rani, the founding CEO of airline AirAsia X, invested all of his savings and took out loans to buy shares of the company after being urged on by founder and investment bankers. Of course, people who sell commission-based financial products like stockbrokers and insurance agents make money no matter what happens. Osman Rani himself believed in the concept of, quote, skin in the game, end quote. The AirAsia X initial public offering, or IPO, initially yielded a 600% return. So, Osman Rani seemed to be rich, at least on paper. He was going all in. In 2007, the airline owner urged Osman Rani as CEO to invest his wealth rather than be awarded stock options. Investing nearly all of his wealth was a stretch for Osman Rani, but he did it. Before the IPO in 2013, Osman Rani trusted his investment banker's advice to use his original shares as collateral for a loan. Doing so allowed Osman Rani to borrow more money from the bank to use towards buying additional shares of AirAsia X at the IPO price. Tragedy led to serious financial loss. So AirAsia X aggressively expanded by using the proceeds from its IPO to double its fleet and focus on China and Australia. Then 3 major airline disasters hit in succession. Malaysia Airlines Flight 370 disappeared with 239 people on board in March 2014. Malaysia Airlines Flight 17 was shot down over Ukraine in July 2014, killing all 298 passengers and crew. Indonesia AirAsia Flight 8501 crashed into the Java Sea in December 2014, resulting in 162 fatalities. These crashes severely impacted the industry and AirAsia X's stock price. The takeaway: a 7-digit loss. As CEO, Osman Rani couldn't sell his shares even as they plummeted. In fact, he decided to buy more. Osman Rani had trusted his mentor and investment bankers and ended up having leveraged investments in AirAsia X. He eventually lost all of his shares when the bank sold them to cover his debt. Osman Rani incurred a 7-digit loss and tendered his resignation. This leads us to mistake number 4, misplacing trust. To avoid this, get to know the person you are investing with, as trust only develops over time. Additionally, avoid excessive leverage like Osman Rani accumulated. Have a backup plan for unforeseen risk and be cautious of financial advice motivated by fees and commissions. Investing mistake number 5, failing to monitor your investments. Creator and host of the weekly personal finance podcast, Money for the Rest of Us, David Stein shared his story in the episode Trading Currencies and Commodities is Harder Than You Think. As he was transitioning into retirement, Stein was enticed by the excitement of trading he witnessed at a hedge fund. With years of investment experience, he ventured into commodity futures and currency options. However, in doing so, he underestimated the difficulty of trading the undisclosed trade. Despite his knowledge, Stein found trading challenging. He decided to stop but forgot a buy order he had previously placed. This order was to automatically buy silver if the price fell to a particular level. When silver's price dropped, it triggered the buy order. The purchase led to an unexpected loss of $25,000 as silver continued its collapse. This oversight turned into a costly mistake made by a seasoned investor. The takeaway? Stein's experience highlights that trading is speculative and risky, even for experts. The key takeaways are to always monitor your trades and never underestimate the market's unpredictability. The loss reminds us of the importance of vigilance and caution. It also brings us to our 5th mistake, failing to monitor your investments, in this case, outstanding orders. To avoid this mistake, follow a regular, predetermined monitoring process. Investing mistake number 6, investing in a startup. Viola Llewellyn is the president and co-founder of Ovamba Solutions Incorporated, now helps empower women to succeed. She told her story in the episode Learn to Embrace Failure, the promise of peer-to-peer lending. So Llewellyn and her partner Marvin Cole launched a peer-to-peer lending platform for small African market enterprises with initial investments from friends and family. They soon attracted the interest of the investment firm at a conference. This seemed like it would be a secure, promising partnership. Because Llewellyn was so eager for funding, she didn't spend the time doing a background check on the potential investor. The vanishing investment. After a glamorous start, the investment firm promised a significant investment but delayed transferring the funds. Llewellyn faced mounting pressure as she had committed to funding small businesses and launched a major marketing campaign. However, the promised capital never arrived. The takeaway is facing the reality. Llewellyn had to retract her promises to her customers and face the embarrassment of failure. The collapse of the investment firm partnership taught her the importance of thorough due diligence and not relying solely on positive references. She learned to do background checks on financial advisors and planners. The process included regulatory agency checks on those professionals and their firms. The experience underscored the necessity of a backup plan and transparent communication with stakeholders. Mistake number 6 occurred when my podcast guests invested in a startup. To avoid losing everything in a startup investment, allocate only what you can lose to startup companies. Mr. Stotz goes on to talk about his worst investment ever. This brings me back to my story. Like Llewellyn, my worst investment was investing in my friend's startup. I found the experience painful because I lost a sizable portion of my wealth. It was also shameful because, as a top analyst and president of the CFA Society Thailand at the time, I was someone who should have been well equipped to avoid such errors. Through my journey of interviewing 800 people on the My Worst Investment Ever podcast, these 6 stories highlight crucial lessons. The lessons underscore the importance of preparation, diligence, and learning from others' experiences to avoid repeating the same costly errors. So, here they are again. Number 1, failing to do your own research. Before making an investment, especially a large one, conduct thorough research and due diligence. In doing so, write down what you found out about your investment idea. Number 2, failing to properly assess and manage risk. Consider the downside risk when analyzing an investment, including its potential volatility. Additionally, always protect your capital and be cautious when everyone feels excited about the investment. Number 3, being driven by emotion or flawed thinking. Humans are susceptible to information selection bias, which means focusing on research and advice that matches your beliefs. You can avoid it by exploring and listening to opposing views. You could do so in the political realm as well. Number 4, misplacing trust. Get to know the person and firm you're investing with. Be cautious of financial advice that is motivated by fees and commissions. Number 5, failing to monitor your investments. Following a regular, predetermined monitoring process can avoid mistakes such as forgetting to cancel a buy order. And number 6, investing in a startup. These are risky investments with high potential for failure. As such, only allocate what you can lose. So, don't put all your eggs in one basket, is another way to say that. All right. That was a great article, don't you agree? If you have any questions or comments, you can reach out to Northbound Wealth Management at 317-399-1107. Thank you for listening. I hope you guys have a great weekend and a great week ahead, and we'll talk to you soon. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.